Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Yesterday, February 4th, 2026, was, well, it was an absolute bloodbath for shareholders of Geospace Technologies. We saw the stock plummet nearly 40% in a single trading session. It crashed from around $17 to under $10 right after the Q1 2026 earnings release. Right now, we are watching this highly volatile range between, call it 976 and 1546. And the volume, it was massive for a microcap, hitting an average daily of over 234,000 shares. That is high liquidity. People were rushing for the exits.
They were.
It triggered what they call the fast bearish crossover on the charts, and that is all the technical algorithms just screaming sell. So, the central question we are tackling today is whether Geospace, ticker GEOS, is a distressed asset, just burning cash into oblivion, or is this massive drop a rare opportunity to buy a debt-free, asset-rich tech company at the absolute bottom?
And that is a terrifying question, isn't it? Because you look at that chart and it is a textbook definition of a falling knife. I see investors looking at that drop and thinking bargain. But when a company reports a 31% revenue decline and a net loss of nearly $10 million in one quarter, well, the market isn't reacting emotionally. It's reacting to a structural failure. You just can't ignore the context of that volume spike. That's capitulation.
I think structural failure is a gross exaggeration of what is actually just a timing mismatch. My position is that the market has fundamentally misunderstood Geospace. They see it as a dying legacy oil field service company. They have completely ignored the fortress balance sheet. We are talking about zero long-term debt, and they own their real estate in Houston and internationally unencumbered. Investors are panic selling right before a $90 million Petrobras contract kicks in. This is a deep value turnaround play.
And I'm taking the position that turnaround is often just a polite word for a company that can't pay its bills from operations. You talk about the balance sheet, but I'm looking at the cash burn. Cash equivalents. They dropped from $26.3 million to $10.6 million in 3 months. They are bleeding liquidity. And this rebrand to Applied Intelligent Technology, it feels a little desperate, like an attempt to pivot away from a core business that is shrinking. That 52-week low of 551 isn't just a number on a chart. It's a very, very realistic target if they don't stop the bleeding immediately.
I appreciate the skepticism. I do. But you're looking at the rearview mirror while I'm looking at the windshield. Let's actually break down the business model because that's where the misunderstanding is. You have 3 segments here: energy solutions, smart water, and intelligent industrial. The market treats this stock purely as an energy play, and that's where the volatility comes from. But even within energy solutions, their technology is absolutely top tier.
But energy solutions is still the mothership. And right now, the mothership is taking on water. That segment is. It's just characterized by extreme volatility, or what management likes to call lumpiness. You feast on a big contract and then you starve for 2 years. That's exactly what we're seeing. They are in this starvation phase. The 31% year-over-year revenue decline drives that point home. You can't sustain a company on the hope that the next big contract will save you.
It's not hope, it's a signed backlog. That $90 million Petrobras Permanent Reservoir Monitoring, the PRM contract, that's a reality. It starts recognizing revenue in Q3 of fiscal 2026. They'll use a percentage of completion model, so this isn't a maybe. It's guaranteed cash flow that is about to hit the books. And regarding the tech, let's be specific so listeners understand why this matters. They aren't just selling generic sensors. The Mariner nodes are a massive competitive advantage. They are cable-free, autonomous, shallow water recorders. And their slim profile lets contractors fit 25% more nodes into a shipping container.
Okay, but why does fitting more nodes in a container matter to me, the investor?
Because logistics are the single biggest cost in seismic exploration. If you can fit 25% more equipment on the same vessel, you reduce the number of trips, you reduce fuel costs, you reduce vessel charter time. It's a direct line to profitability for their clients. That makes the Mariner node a very sticky product.
The tech can be brilliant. I'll grant you that. But if the market cycle is against you, it doesn't matter. Look at their competitors. You have DMC Global with a market cap of, 149 million, and Forum Energy around 420 million. They're all struggling with the same earnings volatility. The difference is the market has lost patience with geospace. They keep promising this transition while the core business drags them down. That Petrobras contract is great, but it's one project. What happens after that? Do we just go back to another 2 years of burning cash?
That is precisely why the debt-free status matters so much. Unlike former DMC, Geospace has no interest payments choking them during the down cycle. They own their facilities, they have a tangible asset floor that those other companies don't necessarily have. They can weather the starvation phase without, diluting shareholders into non-existence, at least not yet. But the real story here, the one that got completely buried in the panic selling yesterday, is the diversification into smart water.
Ah, I knew you'd bring up the water segment. It's the favorite talking point for the bulls.
Because it's working. We are looking at 4 consecutive years of double-digit revenue growth in the smart water segment. They have the Hydrocon Universal AMI connector, the Aquana Smart Valves. This is steady, secular growth. It's driven by aging municipal infrastructure. Cities are replacing old meters with smart meters. It's not cyclical like oil. And here is where the valuation disconnect is it's insane. I want to compare Geospace to Badger Meter.
Badger Meter is a $5.5 billion company. Geospace is barely holding on to a $200 million market cap. That's not apples to apples.
It's an apples to seeds comparison, sure, but look at the multiples. Badger Meter trades at a PE of over 30. It's the gold standard. Geospace is trading at a negative PE because of the energy losses. My argument is simple. If Geospace can successfully prove that it is becoming a water and industrial tech company, the market has to re-rate it. Even if they get a fraction of Badger Meter's valuation multiple on their water revenue, the stock reprices massively. You are basically paying for the distressed energy business and getting a high-growth water tech startup for free.
Oris, you're buying a tiny water valve business that is being suffocated by a massive money-losing seismic operation. And you mentioned the industrial segment. They acquired the heartbeat detector from GeoVox, technology for prisons and border security. It sounds cool, detecting a human presence in a vehicle via vibration, but these are niche markets. The R&D required to maintain edge case tech like SADAR for border security, it just burns cash. You need massive scale to make that profitable, and they do not have it.
Well, they're shifting GeoVox to a recurring revenue model. That's the key. They're moving from one-off hardware sales to subscriptions. That creates predictability. And this brings us to the people running the ship. You can't discuss this turnaround without talking about the new CEO, Rich Kelly. He just took over in October 2024.
Right, the guy from Sercel.
Exactly. Sercel is a major global competitor. He was the president there. This is a big tier higher. You don't leave a subsidiary of CGHG to captain a sinking ship unless you see a clear way to fix it. He brings an operational discipline that, frankly, Geospace has lacked.
I'll give you that Kelly has the resume, but employee reviews suggest the culture there is bureaucratic and slow. Turning a ship around is hard. Turning around a ship that has a culture of, that's how we've always done it, is nearly impossible. And let's not ignore the fact that he has to manage this cash crunch immediately. He doesn't have 2 years to fix the culture. He has maybe 2 quarters before the balance sheet goes from fortress to under siege.
So if he was so worried about the ship sinking, why is he buying stock?
Is he, or is that just compensation packages being exercised?
It's both, but it signals intent. And for me, this is the most critical data point. While the market was puking shares yesterday, insiders have been accumulating. Board member Gary D. Owens bought heavily in the 487 to 550 range previously. But more recently, CEO Kelly and the CFO Robert Kurta acquired shares through non-open market transactions, likely exercising options, taking grants instead of cash, which signals they want equity. But the key is looking at the open market. There has been virtually no significant insider selling. If the insiders thought this company was going to zero, they would be hitting the eject button, and they are not.
That is a fair point. I'll concede that. But let's look at the institutional side. You have 57% institutional ownership. Vanguard, BlackRock, disciplined growth investors. That sounds stable, but it's a double-edged sword. If the dividend or the growth thesis breaks further, If that Petrobras contract hits a snag, those funds have very strict risk parameters. They will liquidate. And when 57% of the float tries to exit a microcap with 234,000 daily volume, the door is very, very small. That 550 support level will look like a speed bump on the way down.
I think the institutions are holding because they see the same asymmetry I do. Let's actually run the numbers. Let's do an investment simulation. Let's make this real for the listener. Say we allocate $5,000 right now. At the current volatile midpoint of, let's say, $15.50, that gets you about 322 shares.
Okay, let's play this out. I'll give you the bear case, which is my base case. The cash burn continues. They burned through nearly $16 million in cash equivalents in one quarter. If they have to tap that $25 million credit facility, the zero debt thesis is dead. The market panics, the stock tests $10 again, or breaks lower to retest the 52-week low. In the short term, let's say it settles at 10. Your $5,000 is now worth $3,220. You've lost almost $1,800 or 35% of your capital in a matter of months. That is a very real risk.
It is a risk, I acknowledge that. But now look at the midterm and long-term reward. Midterm, let's say 1 to 2 years out. The Petrobras revenue kicks in. That $90 million isn't theoretical, it flows through the income statement. EPS returns to roughly $1 per share, which is where it's been in previous up cycles. If you put a modest 15 times multiple on that, or just look at historical peaks, a $25 price target is reasonable. In that scenario, your $5,000 becomes $8,050. That's a 60% gain.
And that relies on perfect execution of the contract and no further deterioration in the legacy business.
But let's look at the long term, 3 to 5 years out. This is the applied intelligent technology thesis. Suppose the diversification works, they get to 70% non-energy revenue. The market stops valuing them as an oil service firm and starts valuing them closer to an industrial tech firm like Badger Meter. We don't even need the 30 times PE of Badger. Let's just say we get a price-to-sales ratio of 3 on projected revenues. That implies a stock price closer to $45. Suddenly, your $5,000 investment is worth $14,490. That is a profit of $9,500, a 190% ROI. The downside is losing 30 or 40%. The upside is nearly 200%. That is a classic asymmetric trade.
It's asymmetric if they survive the transition. You're assuming the cash burn stops. I'm looking at the immediate future. February 4th was a wake-up call, and February is historically a terrible month for this stock. Data shows it only has about a 45% win rate historically this month. You are fighting seasonality, you are fighting momentum, and you are fighting a balance sheet that is deteriorating faster than the revenues coming in.
And I'm saying that you buy when there is blood in the streets. The RSI is hovering around 35. It's approaching oversold territory. The price action yesterday was pure capitulation. That fast bearish crossover you mentioned, that's often a lagging indicator of a bottoming process. The smart money, the insiders, they're already positioned. They own the real estate, they have the contract, and they have the new CEO.
Let's talk about that real estate for just a second. It's great that they own it, but real estate is illiquid. If they get into a cash crunch, they can't sell a factory in Houston overnight to pay payroll. That fortress is a lot less liquid than you think. And with the smart water segment, yes, it's growing, but is it growing fast enough to offset a 31% drop in the core business? The math right now says no. They need that Petrobras money yesterday, but it's not coming until late 2026. That gap is the valley of death.
It's a valley, certainly, but they have the credit facility if they absolutely need it. Utilizing a bit of debt to bridge to a guaranteed contract is not a sign of failure. It's just standard corporate finance. And let's not forget the macro environment. We're seeing a consolidation in the energy sector. Larger entities are looking for efficiencies. The Mariner node, offering 25% better logistics, is exactly the kind of efficiency big oil needs right now. GEOS is positioned to be the premium provider for the survivors of this energy transition.
Or they get squeezed on pricing because the oil majors have all the leverage. And what about geopolitical risk? They've already had to divest their Russian subsidiary. They are manufacturing in Houston, which is good for quality, but management has explicitly warned about tariffs and inflation eroding their gross margins.
If the cost of raw materials goes up, that burn rate just accelerates. You are betting on everything going right in a world where a lot is going very wrong.
And I'm betting on the tangible assets and the backlog. The risks you mention are real, but they are priced in. When a stock trades at a negative PE with this level of asset backing, the market is pricing in bankruptcy. And since I don't believe bankruptcy is on the table, not with a zero debt starting point, the stock is simply mispriced. It's that simple.
We will see. To me, the strong sell technical indicators are there for a reason. The moving averages are broken. The 50-day is way above the current price. Investors who buy here are trying to catch a falling knife.
And investors who sell here are giving away their shares at the bottom.
Let's wrap this up then. My final warning to the listener is this. The chart is ugly. The financials show a company that is hemorrhaging cash, and the upside relies entirely on execution that has not happened yet. If you put your money here, you are betting against the current trend, against the seasonality, and against the reality of their current bank account.
And my final thesis is that the market is manic depressive. It has overreacted to a lumpy quarter. You had the chance to buy a company with a $90 million backlog, a growing water tech division, and a debt-free balance sheet for the price of a liquidation sale. The insiders are buying, the technology is superior, the risk-reward ratio is heavily tilted in your favor.
A fortress balance sheet doesn't matter if you burn it all down just keeping the lights on.
And a falling knife is just a discount if you know how to catch it by the handle. That's the debate. We'll leave it to you to decide if GeoSpace is a trap or a treasure.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.